All right, guys. Good afternoon. Like I said, we'll try and bash through all the indicators today. So either we might run over. If you guys are happy with that, then it does mean you can spend more time on a more focused exercise, which I think probably hammers home the points a little bit better than me talking about them. Not everyone always picks up everything. To start with, we're going to have a look at a few indicators that I certainly watch. ATR a little bit less. I have an ATR up. What I use an ATR for more is just a gauge of what's going on at the moment. I think in terms of trying to use it for a trade, I feel it's a little bit subjective, but we'll have a little talk about it in terms of what it's attempting to show and how I think a good way of using it. We'll have another look at, well, not another, but we'll have a look at Fibonacci's again, where I think they're worth using. Certain markets, and you'll have to work this out in your markets, what they prefer. Certain markets like certain fibs. In particular, and this isn't something I've just noticed, which is quite satisfying that I've heard other people as well say this, the DAX particularly likes a 618 retracement. Why, I don't know, but it does particularly like it. I think that's due to the DAX generally overextending moves, so that 618 retracement comes in quite a bit. Oil as well, I believe, is quite good at holding the 618 retracement, so understanding which retracements your market likes is quite important. We'll come on to those. I've got a few examples coming up. So let's start up with VWAP. Sorry, my phone's going off. What's VWAP? Volume weighted average price. So the idea of VWAP is it gives you the midpoint of where volume is traded to. So you sort of your average volume. The point of it is to gauge where value is in the market. So theoretically, anything above the VWAP is good value for a seller. Anything below the VWAP is good value for a buyer. Now, the reason that this VWAP is so important is it is something used quite frequently and quite extensively by brokers, by execution trading algorithms. The idea being that if you are either an individual or a hedge fund, a client of a bank or a large broker, you will ask to get your order above VWAP, perhaps if you're a seller, or below VWAP if you're a buyer. So the aim of the broker is to get their client as good a price as possible, and certainly at least beyond the VWAP. So what this means, the VWAP can actually end up being used as a bit of a target, i.e. as the market moves away from it, demand comes in from the brokers, from the institutions, to get their buys away whilst beyond it. Equally, you have the other side of things whereby if, say, your client has said, right, I want you to buy as close as or below VWAP as you can get, and you're in an uptrending day, you can end up with the VWAP actually providing support on that day because of the fact that it's an uptrending day. If they don't get those orders done at the VWAP, they're going to have to go out to their clients and say, well, actually, you got VWAP plus 10% on the day, something like that. So depends on how the day is progressing, whether the VWAP ends up being used more as a target or whether you end up using the VWAP more as a support or resistance for a trade. Non-trend days, obviously, you'll rotate around it, and this is where you have to sort of look at the day, look at what's actually going on and say to yourself, should I really be playing anything off a VWAP today? And you'll find that in quite a few instances, it's not the one. You take the DAX today, for example, Euro stocks the same. Trading around the VWAP today, you would get chopped both ways on it. You buy it, you might get a little bit out of it, it breaks. We're trading either side of it. The Bund initially held very nicely above the VWAP for the morning. So VWAP actually managed to hold the Bund up. But you look at the Bund, you'd certainly say the Bund is certainly more a trending market today than European equities are. My favourite way of using it is an entry for a continuation. So the idea being this gives you a passive entry. As the market comes back, gives you a nice point to buy, gives you a stop underneath, buy or sell it. Your target then can be for a new high or a new low. It's a trade I do quite like in the Bund. It's something that I've started to notice in the DAX. However, I find that the DAX is a little bit less keen on using it as continuation, but more as a marker that it will react from. So it will give you a bit of a trade, a bit of a pullback, but won't necessarily give you the actual full continuation trade that you would expect in the Bund. Good thing about it is that it's calculated based on volume, so no one can argue with it in a sense. Whereas if you're drawing a trend line, if you're looking at certain levels, you could have certain settings on your moving averages that perhaps no one else is looking at, they become irrelevant. Whereas the volume in the market is the same for everyone. You can't interpret that. And so the VWAP should theoretically be the same for everyone. So you should all see the same VWAP. There are different parameters that people can use for their VWAP and different averages that you can use. I have seen it on some charting packages whereby the VWAP varies depending on time frame, and this is to do with, I believe, the closes of candles. So it will continually change the average on the close of each candle rather than a continual VWAP that's based around each price that trades. I personally think you want the more continual version. That way you get a constant sense of where the VWAP is rather than waiting for each candle to close, which if you have a little surge of volume on an hourly candle and you're using an hourly VWAP, then you can end up with a slightly skewed VWAP from other people. But in general, it is reasonably irrefutable where the VWAP is. And the fact that you have a lot of client orders from banks, brokers, etc., traded around the VWAP, that makes it that little bit more important. You can be confident that there will be some genuine trade there. People will want to do some genuine business. All right, so when does it work? This is something I've watched this trade for a while, and particularly in the Bund, and this is where I sort of started watching VWAP in particular. Looking at the idea of trying to stay on a trend day, particularly a grinding trend day. Now, these are the days that I think are the hardest to stay in because of the fact it doesn't give you much opportunity to get in. It doesn't move particularly quickly. So you end up stuck, sort of thinking to yourself, well, I'm missing out, it's going. You end up stuck missing the trade. As time's gone on, and we'll talk about this when we do trade development a little bit, as time's gone on, I've started noticing that the best VWAP trades, particularly in the Bund, are when you get a gap that either reverses or continues. So once you've got a gap, and I think this is to do with sentiment and how people want to get their orders filled. So look at it from this point of view. If you're a bank and you've been given an order to try and buy at or below VWAP, and you get a day that opens below the previous day's low, charges straight up, first pullback holds VWAP, second pullback holds VWAP, fifth pullback holds VWAP on a 15-minute, you're then going to start buying VWAP every time you get there because you can't be sure that you're going to be able to get your clients' orders away down here. So it provides buying around that VWAP. So the way I also like to look at it is in terms of the distance it moves away. I don't think there's any point in buying it straight away for the risk that what happens is the first pullback hits the VWAP, moves sideways, you then end up with a VWAP moving through the middle of the day and it trading around it like this. you're always going to get caught out. So as a general rule, I want to see the bund get around about 20 ticks away from VWAP, then pull back to it. So that pullback, when you've got around about 20 ticks away, so up here, down to here, that's 52s. That high is 73. So you've got 21 ticks on the pullback. Next one's even better, 82s down to 56s. So you've got about 25, 20, about 26, 27 ticks there. That's where you're looking to execute a passive trade. So you literally sit in there on the VWAP, you get filled, target is a new high. So both those instances, you get that new high trade, a little bit like that high volume 15-minute candle. And this is where it really helps. If one of these 15-minute candles here is the high volume of the day, for me that makes that trade an even better trade. Sets it up even nicer that you want to be long anyway, you've got a reason to be long, and now you're being given an entry point on it as well. So that's how I look at it on these sort of trend type ones. I do feel that, having watched it a few times, that these gap ones that then start to go seem to be the better versions. Today we didn't really get a gap, but we did get the push away from it. Unfortunately, on the move back, we've not managed to hold it. And then we've ranged across it today, so I might bring that chart up in a minute and we can have a look at it. So yeah, that's how I like to look at it on a trend type day, particularly as grinding trends. In the end, after the little gap down just here, bund actually turned over and reversed, and we ended up with a much, much lower drop. But initially it held it quite nicely. Right, here we go once again, another situation in the bund. There's a 15-minute, there's a 5-minute chart, and you see it. This one's now started to reduce the amount it needs to pull back. You've got here 40s, and we get the pullback down to 30, so you're only getting 10 ticks. Again, 50s down to just below 40, but it holds it every single time. And once again, you've got that same setup whereby you've had a gap down that doesn't continue, starts to move up, the VWAP holds on each of the drops. So that's what you're looking for. It's quite nice on this one that you get this little range trade, quick drop down, hits the VWAP, and then gets bought straight the way back up. The next drop down does give you your 20 tick move, holds it, bounce, and this is where it's tough because it comes back once again. But give yourself a stop. If you bought this the first time, you've got a little push through, no close below, you've then got a quite nice easy stop just below there on that VWAP trade. So that's how I'd use it for a trend type trade. I do think it works perhaps better in the bund than it works in a lot of other markets. European equities don't seem to hold the VWAP too well. S&P will hold it briefly, and more gives you sort of a scalp opportunity in the S&P as opposed to a full-on continuation type trade. I think with all of these indicators, I think the biggest thing with any indicator is it's giving you a reason to take a trade on. And if that coincides with another reason, then I think it's quite a good trade. It's when you're taking on a trade for no other reason than it's a VWAP or it's a moving average, it's a whatever. That's when those trades diminish in quality. So you start then, not quite hoping, but you're using one reason to take the trade on. If no one else is going for that reason, you're then stuck with a trade that sort of loses quality, basically. All right, so let's go and have a look at markets reverting to VWAP. And the way I look at this is once you get a situation whereby the market pushes back through it, particularly if you started off looking like we're getting a bit trendy, Once you go back through it, the market then will hold it the other way. So it's as if support flips to resistance. And again, this could be that situation of, you've got orders to buy it below VWAP. This is great, getting all these orders filled. Once you get the move back through, there's then an incentive to actually buy it as we drop back down. Yes, you get the break down here, but there becomes an incentive to actually buy it as it comes back. Likewise, if you're trying to sell it above, that's where the selling's going to come in to start with. Breaks back above, everyone's then happy to sell it. And because it has trended below it, that's where you can then get the sort of suck back to it, because this is now the opportunity for those people who did need to sell it above VWAP to actually get those sales away. So once you start reverting back to VWAP, where you start trading either side of it, that again can quite quickly become a nice indication of a bit of a range type day, a day where you don't really want to be trying to play too much breakout. Happens 2 days in a row here, and this is something that I find works quite well, that you will consistently see markets that if it does a pattern one day, it will repeat the pattern the next. So on this day, we got a gap up, couldn't push higher, dropped through the VWAP, doesn't really show any sign of going lower. You've almost got this, you have got this delta reversal situation as well, whereby you've got delta rising all the way through this. Get the trend break, pulls back, so it wouldn't stop you out, although it would put you in a little bit of uncertainty. Then once you break back above the VWAP, you then start holding it. Exactly the same situation the following day. You get delta rising, you get this wedge down at the lows. As soon as the wedge breaks, we break the VWAP, and then first time back, you get a scalp trade back up to this range. Then we start messing around with it a little bit, but at no point do you actually get a close back through it. So it's for me, you get the reversion to VWAP once you've been one side of it, move back through it, and then you'll come back to it again and again. Basically just showing that any kind of move on the day does not want to continue. So sentiment's switched, and now sentiment's moved to a more neutral type of day. I was just going to see if we got a nice little example of that in the DAX today, but no, it looks like more we've just traded all across it all day, which is not ideal. Yeah, it is still there. Another example of it in the DAX, again, this is where we do hold it a little bit, but this is one of those where you can look back in hindsight and say, yeah, this is a lovely little trade, sell the VWAP there. Problem is, earlier on in the day, your clue's there that this probably isn't really a trade. I think the fact that we came off from here is more coming off from the bottom of this range than coming off from the VWAP. And that's where, when you do go back and look at sort of setups, look at ideas, you've got to question how much this actually had to do with the VWAP. Nonetheless, we move away and you get this similar type pattern again, that downtrend. Once you break above it, we then start to hold it the other way round and move on higher. Here again, another Bund revert to VWAP, and this is one that you can play for that reverting to VWAP trade. I mean, that's the main bit with this. Rather than you're playing a continuation, you're actually trying to find a way to play the reversion back. And both times it's this sort of struggling downtrend that gives you that clue to play the reversion. Once you get the break, that then gives you a nice target. There's your second target on that trade. Bund, you get this struggling uptrend, after you've had this quite decent breakout. As soon as you get the break, it gives you a very nice little target down there. That is a nice target of 15 ticks. Really does take its time though. this is a 5 minute chart, so you got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. 13 candles, so it's taking you an hour and 5 minutes to do 15 ticks, so you're making about a tick every 5 minutes, which is quite tough to take, but nonetheless, you've got a double top, you've broken the double top with a trend break. It never puts you in any trouble here. It never really pushes back above the previous 5 minute candle, so as long as you're willing to just sit and wait, it does work out quite nicely. You get a nice little target back at the VWAP, and that gives you your out. Go and have a look at it today, and
Euro is just bouncing.
sorry,
Euro is just bouncing.
euro.
Well, not exactly, but very close.
Oh, what, the euro's bounced off his VWAP?
Yeah, but yeah, it could go over perhaps. Who knows? But right now it's bouncing.
Yeah, I see what you mean. You look at that. Yeah, not bad. I think the only thing that puts me off that is the fact that we did start out underneath it and then move back above it. But the fact we start off out beneath, move back above, yeah, at least to start with, you can, you start having a go at that, sort of revert back to it. The only thing with the reverting back, if you're buying the VWAP, I wouldn't always be looking at that necessarily to create a new high. Maybe look at it as more of a trade to move back into the range of that previous area before the pullback to it. We'll see now though. You know, it's
My bet is going down because on our like 4 hour
yeah.
4 hours chart, you have kind of like head and shoulders, another one like with double head, and Euro likes it a lot. So it's 123.68. It's the high of the left shoulder, and this is the same area we are reverting from.
Okay. So where's your head and shoulders in here?
With double head.
Oh, so you were saying
left
shoulder, head,
yeah.
shoulder.
Yeah.
Yeah, I see what you mean. You just got to see now whether you do actually get the break. So
Yeah, but it's a good location, definitely.
Well, for sure.
Yeah.
I see what you mean. Like you're at the bottom of this previous range, so if you wanted to take that short, it's the only problem is it's a bit speculative in the sense that if you'd almost need to look at it as two trades, that you could look at this as one trade to get a short at the bottom of this range to play it back down to the bottom of this range, and then if it breaks the neckline, which would come in just there, then you can stay in the trade or add to the trade. But for me, if I was playing this from here, I'd be looking for a move to the bottom of the range rather than
Yeah, they would bounce a bit.
Yeah. Might give you an opportunity to sort of take some profit here and then set yourself up for a go at that head and shoulders. But yeah, you do kind of have, you could argue, if you didn't want to call this a head and shoulders, that it's a double top. Yeah, there's your two highs. There's the confirmation break, and you're pulling back to that confirmation point. What's also quite nice, we're going to talk about this in a little bit, these moving averages working very nicely. So what I have on most of my charts, I have a 50 and a 200. I think they're probably the most important moving averages to have. Incidentally, if this was on an hourly, that 50 will be the 200 on the hourly, obviously. It's 4 times. And then the 50 is not quite so clean on the hourly chart, but yeah, I can see that double top, head and shoulders type pattern playing out. I think you're on quite a key area now. Whether we manage to hold this sort of 200 average, or we can hold below this little range if we can, then yeah, I think you could be set up for a little bit more downside. But the Euro's already had one of those earlier on. Yeah, that one I showed you yesterday.
The nest kind of like.
Yeah,
nest.
it looked like it wanted to do it and it just couldn't do it. But that's not to say that this one won't work. So.
Apparently there's also one oil grid.
Great reversal VWAP with a break of range, oil 5 minutes as well. Okay, let's go and have a look at the oil one as well. Good to see people spotting these though. Favourite indicators. That's what my VWAP looks like on TT. I'm
Bounce.
not. Yeah, I guess it's giving you the standard deviations on it as well. I'm not quite seeing the breakout or the sort of VWAP trade on that though, because there's the VWAP and it's definitely traded either side of it. And then again we traded either side of it there. So not overly keen on that for too much of a trade there, unfortunately.
S&P's sitting on it right now.
All right.
5 minute chart. It's just been there for it broke through it and sat there for half an hour.
VWAPs everywhere. Let's go have a look at the S&P.
So we think, well, it's also, to be fair, it's also just got a technical level.
It's hugging.
Oh yeah. Yeah, it's kind of messed around with it a bit in the overnight session. Oops. But yeah, this is one of those kind of, I think if we had a bit of a deeper drop here and then a pullback, because it does coincide with a level,
Yeah.
it helps you out a fair bit. The fact that we've closed above it, then we sort of sat above it, then we're not really moving away from it. I wouldn't be too
No, it's way more
fussed
level
on
than
that.
that.
Yeah. But we have broken this little trend, so that's reasonably key. But you break the trend and you can't get through those 45 and a halves, it's still not really showing too much. From an hourly point of view, you've basically got a little, this is a little block area, from like 44s down to 37s. Get out of that either way, I think that could be slightly telling for the S&P. In terms of Bund today, this was the one that I felt was perhaps the best one, but it ruins it quite quickly, and that's one of those trades where you will get stopped out on it. The only perhaps saving feature of this is if you're looking for a 20 tick move away from VWAP, you've not got it because you went 44s and the VWAP's down at 27, 28. I'd argue that's good enough for 20 ticks. And then you would have got stopped out, unfortunately. And since then, we have then just traded either side of the VWAP. So it held it a little bit here once we got back above it. It's still hardly convincing for the Bund. What the ideal trend continuation trade is, we drop back here, you buy it here. I would usually give it around about 5 tick stop, and I would expect a break to a new high. Not seeing it. This trade does seem to be diminishing a little bit in the Bund, but it's still there. In terms of a reversion one, got the move lower yesterday, and this is one where I would expect more to see reversion around the VWAP than trying to play off it for any kind of trend, because of the fact that very, very early on we chopped both sides of it. That for me is a very quick indication that we're not going to be trading off the VWAP for the rest of the day. So yeah, but unfortunately not really playing ball with it, but I think that's just a situation of the slightly lower volume that we're seeing in the Bund. It just doesn't really want to do a great deal at all. You might have a little flag on it though, just here. Yeah, I'd call that a little flag. As long as we stay above 18s, then perhaps we do have another leg in it. Okie doke. Right. Let's go have a look at VWAP reversals. This type of trade where basically what you're looking for is a market that is traded one way and then fails and then reverses back through the VWAP. Bund does it quite nicely with these type of block trade situations. Again, if you've seen it trade both sides of VWAP already, then that's giving you a little clue that you'd be quite happy to try and play the market through the VWAP as opposed to play it back to it. Play from it, continuation. So if you are long on this trade, you can then be looking at that VWAP potentially as a point where you're going to get a little bit of acceleration through as shorts give up on the trade. Once again, exactly the same thing here. We've very clearly been either side of it. Push out of this range. That becomes your first little area where you can say, right, we get above the VWAP, then I'm going to expect a much larger retracement. So is that move back through it after you've had some kind of structure that shows you some direction going back to it. Yeah, it's the way that it does this bit that makes the difference. If this is the kind of move that comes down and then waves back, then it's more likely to hold. But the fact it comes down and just consolidates is not showing any desire to come back and find any more sellers. And the longer it sits there, it collects sellers down at these areas who then will start getting out as the market pushes higher. So it's all about that structure just beforehand that makes the big difference. Likewise, same with the continuation one. You need it a certain distance away. Ideally, if you've got a high volume candle, a reason that the market should continue, that's a little bit more help as well. Any other questions on VWAP? I don't use it that extensively for too many trades because the fact I find that as soon as the market starts switching both ways across it, it's never going to really give you any sustainable trade. It's going to continually give you small scalps, but equally the scalps are likely to be very small to the point that if you get stopped out on that scalp, you're going to lose what you made on the previous trade. So for me, it is very much just a sense of where the direction is going and to be used in specific circumstances, i.e. that gap situation, and use it as a trend or as a target on any kind of reversal trade. Shift back to the VWAP becomes quite a nice little target. All right, ATRs. This is the average true range. It is a volatility indicator, so the idea is as your ATR goes up, it implies greater volatility. I'm not going to explain the workings out of it. You don't need to know the workings out of it because you're I only got to A-level maths, so I didn't get this far. Yeah, it's volatility indicator, so theoretically as it goes up, you should see greater volatility, you should see larger ranges. The idea is that it tries to create a more true range, and so something that's a little bit more stable than, the range yesterday was 150, the range today is 300, the range the next day is 60. It doesn't really give you any consistency. The way it can be used is in indicating whether a move that you're on still has a bit more potential in it. And perhaps something that we should have been remembering last week, that as the ATR is expanding, you can then start playing setups for a much larger type move. So if, say, the current ATR is 150, the current range on the day is 50, and you get a flag form for a breakout to the upside, based on the ATR at least, you can start thinking to yourself, well, this has got potential. This could well go because the fact we've still got this extra space on the day. If you've already done 150 ticks and the current ATR is 120, you've got to question how much further it's going to go. So that, I think, is probably its most powerful use in at least limiting or encouraging a trade to play out. The other way of using it is as a contrarian type idea, that it makes a level stronger if it's got beyond the ATR. So if you've got a level way up, market starts trending higher, go significantly beyond the ATR, makes that level a little bit stronger. So if you always wanted to trade that level and the ATRs, you're beyond it, makes the level better. Likewise, if you're sitting on the level here and you've done a 20 tick range and your current ATR is 150, this level's probably not as strong anymore, and the move lower is going to be a little bit easier to call, easier to manage, easier to take on. The only difficulty with the ATR is that's all fine until it breaks the level that is beyond the ATR 150 ticks away, and then you get this range expansion. The ATR is then going to slowly catch up to it. So in a way it becomes a little bit backwards looking, that you kind of already know that ranges have expanded, volatility's increased, and then your ATR goes up. So for me it is slightly behind the time, but I do think it works quite nicely in just giving you that sense of whether there perhaps is a little bit more in this move. One last thing on ATRs, what I always have my ATR set at, because like any moving average or volatility indicator, you can set your own parameters on it usually. I have mine set at a 21-day exponential ATR. The reason for that is there's approximately 21 days in a trading month. The reason I have it as exponential is I want more weighting put on the most recent days ranges. There's no point in next week all these European, US equities catching up with the ATR because the average has taken off some of those lower ones from last month, and then going, oh yeah, range is much bigger. Probably at the point when ranges are likely to get a little bit smaller. So I try and sort of manufacture it, if you will, that it takes in a relevant period of time, but also weights it towards what the current most active or non-active days are. So yeah, that's really all I'm looking at for the ATR. One other way of using ATR is, and we'll talk about this later on when we're doing sort of daily morning prep, is using an ATR to calculate the open the next day. So what you can have is a ratio of how far, say, the T-note moves in the overnight session should give you a clue, and that's where you get your opening call for where the bund should open. Now, if the T-note has started expanding range, you've got much greater volatility. You can create that ratio by dividing the T-note ATR by the bund ATR to give you the ratio of number of ticks in the T-note to number of ticks in the bund. In practice, it's always been looked at that for every half tick the T-note moves overnight, the bund should open 1 tick in that direction away from its close the next day. So that's the more practical version rather than the working out the ATR, because then you've got to come in every day, work out a slightly new ratio. I think the degree of accuracy that gives you is perhaps a degree of accuracy that you don't need. It might make you 1 tick slightly better off in your calculation of the open, but you're not going to trade it unless it's, say, 5 to 10 ticks out of line anyway. So 1 tick either way doesn't make a great deal of difference. We got a question. Right, yeah, I did see that. It's just, for me, it was just the fact that we'd moved a bit too far through the ATR, not the ATR, sorry, the VWAP. That's what put me off sort of looking at it like that. But Yeah, I don't think that's too bad a shout, really. You got the reversal set up. I think the VWAP was more an incidental thing on that trade. The fact that you'd had that push back through a level in the oil, close lower, and then trace back through. Effectively, you got this type set up. Once you trace back through there, then yeah, I would expect it to drop. Okay, just going to have a look at a couple of examples for ATR. Oh, incidentally, there's a few of these charts that look slightly different to usual. These are CQG charts or market delta from when I created these. Right, so what we're looking at, we are looking at the euro, and what we're looking at is this move here. This is on the daily. You get a spike up above these highs, rush up, hits the level and comes back off. Now, this is a slightly tricky one in terms of ATR. ATR at the time was around about 120. From the open, by the time we hit this level, we've done 120 ticks. Nice little level. This is basically your rounded retest trade, and bang on the ATR of the current trading ranges. However, what then happens is, yes, it makes that level nice and strong, so you can be pretty confident in selling that level. This was over, I can't remember, it might have been non-farm payrolls. It was over a figure at least. Euro got rushed up, hit the level, so like I say, you can be quite comfortable selling that level. Drop straight away back down into range, and we then actually continue much lower for the rest of the day. And this is where the ATR is tricky, because it's done the range here completely. You're thinking, right, well that's fine, got my sell away, we drop back into range, all good. If you're looking at the ATR, you're thinking, well, we're probably unlikely to do too much more than this, and then we break this little consolidation, and then we drop another 120 to the downside. So we doubled the ATR in a day. That's where I'm not quite so keen on it. But it's all about context, really. There was no reason to really be buying down here after you've had that rejection candle. However, the fact that you've got this nice level up here, the ATR can help you take those trades on. So it is a very subjective thing. You are going to have to sort of tailor it to when you need it, rather than always go for, well, that's the current ATR, therefore I'm taking it on. For example, current ATR in the DAX at the moment is 250 ticks. I don't think the range is anywhere near that today. I think the range in the DAX is just about 100. So if you were taking it entirely on the ATR, we've got another 150 ticks to do today. Hopefully, yeah. But the context of what's going on, I'm really not seeing how we're going to manage 150 ticks on the day. And that's the difficulty with the ATR sometimes, but I'll come on to that in a minute in terms of it showing something changes or something changing back the other way. Again, another example of ATR strengthening levels. This is the DAX from the beginning of 2017. ATR of around about 110 ticks. So what it does is it strengthens this level down here, because the fact that we open at 11,620, we drop down towards the bottom of the range, which comes in at 11,520. You got an ATR of 110, so you've done a 100 tick range. That's from here down to here. We then get a splash down of a further 35 ticks right on towards these old highs. That again strengthens that level, gives you a nice easy go at buying it. Likewise, you see it on this move here as well. Drops down towards the level which was the previous lows, but the fact that we've come from that little bit higher up, so we've come from 11,630 down to same area, that's hit the ATR as well. So the fact that we come from slightly lower allows it through the range based on the ATR, and then gives you a nice little buy down here. So another little example of it strengthening a level, particularly in this situation when you've got a very range bound market. You can have that extra sort of confidence that it will hold those areas. So yeah, nice, another extra example of it. Giving you a clue that something's changing, I think this is where it is quite helpful. When you get a situation where you get, say, 2 or 3 days range that's all beyond the current ATR, that gives you a nice little idea that perhaps you want to be trying to get involved, because as those first couple of days create a larger range than the ATR will then start catching up with it. That's then going to bring in more people who are a little bit more backward looking, who will look at that and go, right, ATR's now picking up, volatility's picking up, we can start playing more expansive type trades. So the initial break up above the ATR brings that additional trade in, and then you get a few days, and in fact what we end up with here is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days in a row, all bigger than the ATR, whilst the ATR is rising as well. So it's a nice way of sort of suggesting to yourself that something is changing, and then actually allowing you to sort of make the most of that by changing your strategy, moving more towards a sort of breakout style as opposed to just purely a well, what might have been more the style of more muted trade, more range bound trade, waiting for levels to come and going against the trend. Something changing here in this instance, you get the big break up in terms of range. The blues, by the way, is range, the gold is the ATR. And then very quickly we drop straight back below the ATR. As soon as you see that, you can be quite quick in saying to yourself, right, this looks quite anomalous, we're less likely to get too much more going on here. And yes, the ATR will get pumped up briefly, but it then drops back off. So we're kind of seeing that at the moment. This is the DAX today. Well, it's the DAX today, but a look at the previous days. And what you see in the last 2 days, this current range today, we've done 101 ticks. In fact, we're dropping way back below that ATR. And so what that's sort of telling you or allowing you to do is manage your expectations a little bit. You can start expecting this ATR to start creeping back lower, back towards levels that it's been at previously. Previous ATR, approximately 150 ticks, so not too bad in DAX. That's still quite a reasonable type range. But we can now, at least after we got this big pump up in volumes, not volume, in range, which took us up towards the sort of 300, even 600 tick days. That's where, you know, as soon as you see these first two that pop out of it, you can start thinking there's going to be a lot going on. Drop back in. I think we could now start reducing back. What it also helps you do is when you start seeing it really dropping off, you can manage your expectations again there, in the sense that you're not thinking too much in terms of large breakout type trades. This was the move from September all the way up to November. Ranges were appalling. 2 days of range in 3 months that actually breached the ATR, and at that point the ATR was down at 80. So you were struggling for a 50-60 tick range day back then. So you do need to see the ATR in the DAX somewhere up around the sort of 150 area, I feel, before you start getting too much interest, and then you do start getting a little bit more sort of activity. All right, let's go and have a look at Fibonacci's. I'm a little bit more of a fan of Fibonacci's. I think there's a certain time to use them. I don't like the idea of you'll see some people's charts that they've got a Fibonacci on, move like this, and they've got a fib here, fibs here, fibs here, here. For me, I don't feel that that's all that helpful. For me, a Fibonacci should be used on a very clear directional move or a very fast move. So I would often flick a Fibonacci on after a figure. So you got a sudden move, sudden sort of break on a figure. I'll put Fibonacci on that first bit of move, with the idea that if I believe that we should get continuation, a pullback to on the Fibonacci levels can offer you the place to get in. Now, theoretically, and I'm not sure how much I buy into this, that because it's a natural progression developed by a guy called Fibonacci in Italy to explain the reproduction of rabbits, that's where it comes from. Because it's a natural progression, theoretically, markets are a natural sort of phenomenon, if you will, then it should follow and should adhere to Fibonacci ratios. And that's where all of the numbers come from. They're ratios of Fibonacci numbers, which incidentally, 50% is not a Fibonacci number, but it is almost always there. If you put a Fibonacci retracement on anything, you'll always get a 50%. That is merely the midpoint, so not something I would look at. You've got midpoints that show up nice enough anyway. You've got Marabuzzo lines, etc., etc. Don't worry, in my opinion, don't worry about the 50%. Main levels to watch out for, 38 and 61. Beyond that, you've got a 23.6 and a 76.4. They're the only other two that I'd really watch. I think there is one 88 point something as well, and then whatever the flip side of that would be 11 something. I think really it's the 38 and the 61 that really make a difference. So effectively a third of the move and 2/3 of the move, if you want to be a little bit more rough with it. Now, the way that I try and use it, either is for a passive continuation trade, so a bit like a VWAP, where you're trying to use it to get into a trade and then try and hold on to that trade as the market goes, or it's a profit take on a reversal. Nice example of that the other day, after the European gap down, which I've got a little picture of in a minute. I mean, they're probably the main two things. What you also get, and we'll go and have a look at it, is you'll often get a range situation with a Fibonacci, whereby you have the drop, bounce maybe to the 618, and then it will range between the 618 and the 38.2. That seems to be something that's quite common. If the market doesn't really want to continue, it will just bounce back up and then consolidate that range. So if you are trying to have a go at selling those 618s, it's quite a good idea to target the 38.2 at least initially to see what the market wants to do. If it's going to go lower, you want to see it go lower off the first one, really. You don't want to see it ranging and then trying to hold on to these shorts, because once you've developed a range, the move can be either way from there, and that's what's going to get you out of what potentially was quite a good trade. So for me, I'd look for the bottom of that range, potentially take a bit of profit, and then look for the continuation. I think they're best used when in confluence. The reason for this is that, yes, we can all put a Fibonacci on a chart, but people will put them on in different ways. And so if it coincides with something else, much like all the other indicators, coincides with something else, I think it works a lot better. A lovely example of this in the Bund on a flag break the other day. that it coincided with a level of flag retest, single prints. It's just another reason to make you more confident in the trade. So let's go and have a look at a couple of examples. This is your confluence continuation idea. This is the one I was just talking about in the Bund. This is your 60-minute chart. This is a 15. And what we're looking at is this flag in the Bund. This from a much bigger drop, so this isn't just the pole just here. Much bigger drop, long sort of period flag, get the break, so you get a very solid break. We drop from 70s down towards 70s again, and then you get the retracement. The retracement to this little box here is pretty much bang on the 618 retracement of the whole move down. So this fast move, and this is what I mean about fast moves, the sort of event type moves. This move was over ECB. When you get that quick move, that's when I think the Fibonacci is coming useful, because people start looking for areas to start either taking profit, get into trades, however they want to look at it. Notice also that 38 held quite nicely the first time we went there. Well, sorry, once we got above it, it held as support. So you did kind of get this range between 618 and 38.2. Couldn't break the 618, and like I say, that coincided beautifully with these previous lows and the flag retest. So an extra reason to have a go at that, extra reason for confidence in the trade. Comes off, you get to the 38. As soon as we're through that 38, we then continue the move lower. A little bit of a slower move, but it does manage it. And then, if you do manage to hold on to it, you then get a gap down the next day, which continues, doesn't fill the gap, and then you get that very strong continuation lower. So the confluence, I think, is really key. I think it makes it a much nicer trade. Just gives you more confidence in it. Yeah, I'm not someone who's that keen on selling a market purely because it's 618 or 38 retracement. Right, another continuation type trade. This is one in the DAX. This was from a little while ago, but again, on another solid drop. This was the 19th of October, incidentally. Another solid drop. So what you've got here, you've got 130 tick drop. This on a 1 minute chart. Bounce back up, 618, holds very nicely. I do think if there's one Fibonacci that I would sell without confluence, it's a DAX 618. That does seem to hold rather nicely. Gives you the sell opportunity, and then we drift back down towards the lows. Unfortunately, you don't quite make the low, and then you start moving back above the 38.2. So you can use that as your trailing stop. I.e., once we break down here, let the trade go. If we come back up, then you're likely to be getting stopped out here. Still, you've taken 20, 25 tick winner out of it. It's easy to say, oh yeah, well, you could have taken just over 60, 70 tick winner, but why would you get out here? There's no reason to get out there. The only thing you could argue is there's your double bottom, and as you break that, you could get out there, which gives you a nice 40 tick winner, and it's perhaps the way that you should be getting out of that. So yeah, those 618 is decent. It works nicely again as well on that second move up, but this is when I would now expect it to fall into a much more range bound type trade. Got a question. Do you use Fibonacci retracements and projections to look for harmonic patterns like butterfly bats, etc.? No, is the simple answer. It's not something that I've ever looked into. I'm not overly convinced that because the market does one thing, it has to do another thing. You look at, say, the most recent moves in European equities, I would suspect that if you've got any sort of harmonic pattern that sort of says, well, it should move in this way, and therefore you know, the move here. I know what you kind of mean, that you'd have a move down, a move up, and you end up with sort of a retracement that creates a triangle. And the idea then is that the triangle projects the next move and almost the time it should take to do it. I'm sure that's not a particularly good representation of harmonics, but the idea is that one move will equal the next move, and therefore you can calculate the size of the next move and also potentially the time it's going to take. For me, I think there's too many other moving parts for this to be something that becomes a viable strategy. I think you've got to take each day for what it is and what it's telling you. So no, I will use Fibonacci retracements. The retracements I think are the most important. You can use extensions, so the idea is that you would then use this 618 and project it lower. So effectively you're adding that many ticks onto the low is the idea there, if you're using a Fibonacci extension. Fibonacci extensions I do think are quite useful if you've got a flag, and rather than sit there work it out, you can just draw the extension on it. That way it will show you where the flag target is, and then it's all marked off. So it does help you in the sense that you've marked off the flag target, so that at least when it hits the full target you can then start assessing whether you do get a reaction to it. But no, I'm not overly keen on harmonics. I just don't really feel that you can just mirror one thing and it's going to tell you the exact idea of what's going to happen next. Being overly predictive, I think, is the reason I don't like it. I don't think you can predict markets as such. You can spot patterns, spot references that you've seen work in the past, and then apply current context to those patterns and decide whether you feel that the risk is worth taking to play that same thing again. But in terms of being able to predict what's coming, I don't think you can really do that. Right, profit take one, and this was on the gap down on Tuesday. If you drew a fib on from the high of the move down to the low of the gap, that first move up off the open, basically where Europe came in and decided actually this is too low. Incidentally, you also get the delta reversal on the open. Delta is very, very low coming into this open. Bought straight off the bat, and the high is bang on the 38.2. The next high coincides with a level just below the 618 retracement. So yeah, this way you've got to use that confidence, go right, there's the 618, but I have got a level. I'm going to sell the level and accept the stop above the 618, or split your order and do half and half on the level and on the 618. And then you get a very nice example of ranging for the market. We sit there in that range for a little period, which is something that we have just done recently as well. So that's your profit take idea. Particularly on a move like this, where that started off, this is a 5-minute chart, that started off absolutely charged higher. It's very difficult to decide really what levels that you can actually decide to take some profit at. Whereas those Fibonacci's, everyone can see this one. That's a very clear, it's the highest point down to the most recent low. That's a pretty clear Fibonacci retracement. So you can see why people are going to take their profit on that. This is this week's trade. Again, if you take the most recent drop in the DAX, this is one that I'm not that keen on because of the much more sort of convoluted nature of the drop. I'm not as keen on this. You know, if this was a much more straight line drop, I'd be a little bit more confident in it. But nonetheless, we have managed to hold the 618, and the fact that this does not coincide with any levels is showing you that people are definitely watching that fib. It's not that, say, the 618 was there, and then whilst you might play it because the Fibonacci is making you more confident on it, you're never going to know whether it's actually just the level at 12,391 that makes the difference rather than the 618. The fact that it's holding here, there's nothing else there, is saying to me that they are actually watching this fib. So 12,184 I think is quite important. And again, the profit take rally stops straight on it. So that's something that I've learned now in the DAX. It seems these first profit take runs will go to the 38 rather than the 618. And then the 618, if you do want to play a short, is where to play it from in the DAX. 618 seems to work reasonably well in cable as well. So a few different places to watch out for it. I think now we're in a situation that until this breaks, and the fact that we are likely to be moving into a more consolidatory week, we could end up seeing much of the week within this little range. It's still a decent range, it's still a 200 tick range, so it's not to say that this is going to be a totally dull market and nothing going on. It's just that ranges are diminishing a little bit, and we could end up just sitting in this for a little while. The longer we sit there, the more likely that when we break, you get a much more aggressive move. Anyone got any other questions on Fibonacci's? When to use them, how to use them? I think I've pretty much covered everything I wanted to do on those. Yeah, I tend not to use them too much until we do get certainly range expansion or a fast move. If there's none of that, I'm not going to look at, you know, smaller ranges or a very limited breakout and go, oh yeah, that's worth putting a fib on. The S&P recently on this drop has made a bit of a mess of its fibs so far. But I do feel that's one to be watching, because this is the whole drop now. So 27.45 is a 618 fib. It's not adhered to any of the others. I think when it doesn't adhere to other fibs, that gives you a little bit of a clue that yes, I'd be watching this, but I wouldn't be as confident that it's going to work as perhaps other ones, because of the fact that it really doesn't seem to have cared so far about any of them. So yeah, that's the S&P at the moment, not loving the fibs at all. Right, we shall move on, and I believe that's the last one. Yep, on there. So next up, we will manage to get it all done today. Bollinger Bands and moving averages. I use these sparingly and use them only predominantly on daily and hourly charts. I have got some examples of shorter term moving averages that I do think have quite, you know, specific uses. I think DAX just gave us a nice little example actually. So I'll pull in a 15-minute DAX chart in a second and show you that example. I don't think anything else has given us too many nice examples today. So, apart from that euro on the 240 chart that we just looked at a little while ago. Right, anyway, let's move on. Right, Bollinger Bands. The way these work is you have a 20-period moving average, and then you have two bands that are two standard deviations apart. The idea being that this basically shows you whether a market is overbought or oversold. You know, it's gone too far, it's outside of value. Does this and it becomes a more dynamic indicator, because as the ranges expand, the bands become wider and wider. So is a little bit more dynamic than compared to another indicator that perhaps there's a move of this size is an overbought or an oversold move. As they contract, then you expect less and less volatility within the market. You expect less and less breakouts. However, the other way of looking at that is as the bands contract, they are surely at some point going to expand. So that's almost the point where you can start thinking about where the next breakout is going to come from. Watch out for, and again, this is something that you will have to work out in each market, what constitutes a very tight bands. So if you start seeing bands drop to a certain level, you can then start thinking, I'm not seeing it this tight before. That's where you can then start thinking about breakouts, because the bands will come in slightly slower than the move. By the time the bands then come in and sort of flatten out, that's where you can start thinking breakout could be on. Markets moving outside basically shows that you should be playing that market back into value. This is something that I think works rather well on opens. So if you end up with an open that you've got a reason to want to buy, but it's also significantly below the Bollinger Band, the outer bands that is, then you can, again, it provides more conviction in the trade that we should at least rush it back to the band. So that's your contrarian strategy. Most basic strategy, or the more conventional strategy, is that you're looking for a move to the top of the band or the bottom, and you just play it back in. So it's a mean reverting strategy. Problem is, you've got bands that are going like this. If the market goes outside the band, you sell it, 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 in the hope that it comes back. Problem is, if this market's still going higher, by the time it comes back, you might not even be able to get your theoretical profit take below your average price. So that's the risk with that type of mean reverting one, that as you sell the top of the band, you are naturally likely to go further and further offside on the trade until it comes back. So you will sit in a lot of pain offside for it to then flip back and put you onside or put you back to flat. So that's where the danger with that type of mean reverting strategy comes in. And again, context is very key there. So I'm just looking at Bun's made this sort of little block below 23s down to sort of 17, 18. If that rolls over, you could end up seeing a little bit of pace to the downside. Alright, so let's go and have a look at conventional strategy. This is your most conventional, simple idea that you're going to want to sell the top of the band. However, that looks very nice here. You sell it, boom, you get out on the moving average. And then you buy the bottom and you move straight away back up. Lovely. Problem here though is you would have sold it here and you end up keep selling it, and then you get out here. So your first sell, exactly what I was just talking about, you sit a long way offside only to then get a scratch, and that's the difficulty with it. This is where I think, again, the way it does it makes a big difference. If you get a quick move up, i.e. here, that's the kind of one that you can sell, because of the fact you've been away from it, you move to it and it holds it. Now if the difficulty comes in that if you sell it and we keep going up, then you're going to have to keep selling it. So this is why, whilst the strategy works, it can often cause you a lot of trouble when it doesn't, in terms of knowing when you need to actually give up on the trade. This is also a reasonably range bound type market as well, which makes that strategy a little bit more playable. The move into it, as you can see from the moving average, was distinctly more trend like, and so going against the trend is always a slightly dangerous type trade to be taking. But in general, this has pretty much worked, and we'll come on to in a minute the ideas of these sharp points on a Bollinger Band, and that's probably my favourite way of using them. Conventional strategy as well, down here, you get the move below the bands. That's the reason to be buying it. So once you get outside of the bands, you're looking to have a little go at buying it and run the market straight the way back up, back into the middle of the bands. Alternatively, you buy it as we get back inside the band, and that's perhaps your better choice. The way I'd also look at this is I wouldn't want to be taking on any trade that hasn't moved particularly quick to it. So this area, for example, just here, we've dropped to the band, we've sort of held on it, held back inside, and then this move is quite quick down to it. That quick move down is a little bit more of a playable move rather than this one, which has drifted down to it and is then sitting on it. You're going to have to buy it and then sit there and hope that it does turn around. Right, the other way of playing it, there's still the more conventional strategy, and it's a conventional strategy in terms of you're playing the mean reversion, but you're allowing yourself a little bit more chance to take it on. The way you do that is by actually waiting for it to move back inside the band. Give yourself a chance to sell it with some kind of clear risk reward rather than blindly buy or sell it. So this example is really nice, that you get the big drop out, close back inside, and then you can buy it from here. You've already got the rejection type candle, buy it from there, back up towards that midpoint. Once through the midpoint, you can then play it up to the other end of the band as well. So that's your other way of taking these type trades on the more conventional strategy, that once you get through the middle band, or the middle moving average, you should then rotate towards the top. Again, we see it, it's once it dips out, that's where you want to have a go at buying it. We actually managed to hold this quite nicely. You see the range contracting quite a bit here. These spikes out, yes, you can have a go at selling that, but the problem you're always getting there is how fast is this going to keep going. And then things change, and this is where it becomes dangerous. You've got this sort of tight band, then we start to break lower. Once you start breaking lower, you'll find that actually you end up hugging the bottom band, and so until you then put in some kind of sustained move inside, and this way you could get caught out just here, you don't want to be buying it. What also helps out is as the market comes back inside, this moving average is going to slow down. The lower band's going to come back up as well. So you can wait until that lower band tilts back up, which can help you out, but you are going to have to wait that little bit longer. You look here, you're buying it on the way back in, this lower band doesn't tilt back up until here. So if you're looking purely on the lower band, you're not going to be buying it until here. Yes, it still works, but you've got a much nicer position earlier on. So that's your move back inside. I think personally it's more about wait for it to come back in and then find yourself a trade, find yourself a reason to be longer. With any indicator, that's the way I use them, that it's telling me something that I want to be doing rather than telling me exactly the trade that I should take on. Right, contracting ranges. Like I say, you have to work these out depending upon what market you're in terms of what becomes a very, very tight range on, say, a daily chart, on an hourly chart. Bunds in this example, we get down to a range of about 100 on the dailies. That's around about as tight as it gets, so don't think you're going to get too much below 100. Euro stocks, I've seen those drop down towards like 30, 40 in terms of range. You get much, much tighter ones in stocks. But once you see that, that's what's giving you a clue that we are likely then to get that range break. And this again is looking back at, we had this sort of wedge almost, and this was that post-Brexit trade that we looked at the other day. Bollinger Bands gave you a nice little clue as to the sort of false break of the range. So as we broke the range, we broke out of the bands. So you can have a little bit of a guess that this might be a false break. Once you drop back inside, the false break is confirmed. You know that you're now going to get people playing the Bollinger Band at least back down towards the other end. And then once you get through the middle, then you get the move out. This is the only thing with, if you're looking at Bollinger Bands, that as you break through the bottom of the range, that's what's likely to then get you out of the trade. All good, all happy with that? And then what you also get is, because the moving average is shifted, you then get this widening of the bands out of this much tighter area. So once you get the break of the tight area and a bit of movement, the bands then widen out, and that allows this move that then comes back in to take a much larger move higher before we reach the top of the bands and then surge all the way back down. In general, you're not often seeing it move too far out of the bands. In terms of opens, that was the Brexit open in the Bund, opened way above the band. So bands at the time, top band was around about 163. Open on Brexit was right the way up at 165.80, I think. Quick spike up. From a Bollinger Band point of view, that is an ideal sell. We'll talk about opens a bit later on, but there was another reason to sell this. The Bund was opening way too high. So the Bund was always a sell on that. The fact that it was so far out of the Bollinger Band was another reason to have a go at selling that. And it dropped very quickly. I believe the Bund white boxed on that as well. So opened, spike, and then white boxed 100 ticks lower. So if you bought that on Brexit and didn't get out in that sort of 20-30 ticks that it spiked up, you ended up with a 100 tick loser, which was not nice.
Yeah.
As I hear, I wasn't here to trade it, unfortunately. I know Demetrius lost like €1,200 on one lot. Fortunately, he got the rest of them out. So I think he staggered his offers and it hit them all but one, and that cost him €1,200, that last one. Unfortunate, but yeah, if you've got all the rest of them, it doesn't really matter so much. Right, so that's the contracting range. This is why I don't like them on too short a time frame. You get way too much information. This is on an hourly, this is on a 5 minute. And what you get in here, this is your hourly, this is the same day, so here's the Wednesday. All you're getting is a massive amount of chop. Sorry, it's these 2 days that we're looking at here, whereby you end up with one spike out of the range, and then we're back in on the hourly. So the hourly is basically showing you that we're going nowhere. We just had one quick push out of range. On a 5 minute, we've broken the range, we're outside of the range, we're back in, we're holding it. There's just too many things going on. I find that the shorter the time frame, you get weaker and weaker signals, more and more opportunities or perceived opportunities that then don't often materialise. I don't feel that it gives you the clearest cut trades at all. So I would stay away from anything shorter than a 1 hour time frame. In this case, you've got the DAX, very tight little range here. It's on an hourly, so we drop down to about 40 tick range on an hourly. Push up to the top, and then you get a move that breaks the market down. And you see it once again hugging the lower band. That's something that can actually be used to keep you in a trade. In take this example. This is the more contrarian strategy. So contrarian strategy is, rather than going against the bands, as you get a move that sits on the band, that you actually stay long until you get a move back inside, or even until you get a move back below that moving average. It allows you to stay in trades longer. It allows you to hold a much larger time frame, bigger trade. This is the Euro stocks, and this was just on, that was the Swiss National Bank dropping of the peg. Got a very fast drop in the Euro stocks. Next day got bought on the basis that the ECB would do QE, and then we sat on the band. I believe that day was where QE was announced. You get the push up, sits on the band. So if you wanted to be holding on to this, you've got a fundamental reason. We're now sitting on the band with it as well. You can then trail your stop below that 20 period moving average. You get one spike below, that's really where you end up getting stopped out. So if you buy it on this break, you're buying 2,900, and then you get stopped out just below 3,400. Yes, I know from a day trader's point of view, this is unlikely to be a trade that you're going to take on, but it can at least, whilst you can see that it's sitting at the top of the bands, give you that bias to try and stay long. Also, it's showing you that you're in a very bullish market as well, so you can expect that we're not going to see massive ranges. You're going to get slower ranges moving higher, which is symptomatic of a more bullish day. Again, similar thing on the downside, that we hug the band to the downside. So whilst you're not able to get a solid sort of close, notably inside the band, you want to stay with it. So that's your much more contrarian type strategy, just sitting on the band, sitting with them. Yes, of course, as you push up to the band, sort of on these days here, that's where you might want to start thinking about getting out of the move, and that's what's limiting its sort of explosive push. But it's at least not telling you that you want to go short just yet until you get the break lower. Once you get the break, then you know that there's going to be other people looking at a similar type strategy, and that's where, even if you're not trading from a daily point of view, knowing where that break comes in is where you might see some people start getting out of trades. All right. Steep bands. Now this is probably my favourite trade on Bollinger Bands, where you get a very, very steep band. Gives you, if you get a quick move down to it, very, very clear reversal trade. So what I'm looking at here, this is a daily bund. You get this quick drop down towards this band, which is virtually vertical, if you sort of take away the rest of it. So as soon as you see that, I'm always going to be looking at that thinking I'm buying that. The market can't really push too far through it because of how steep it is. You're going to get people buy that straight away. The moment it ticks through, it's showing that it's oversold. As it happens, we get the drop down, and this is where we hit it. The band came in at 15. We dropped through, we traded down to 12s, and then you got a quick run back up to 40s. And if you held on to it from a daily point of view, you get the run all the way back up. Excuse me. You get the run all the way back up to that moving average. Now, it is a daily situation, so the first move, nice, gives you the trade straight off. Later on that day, you do get a dip through 15, so we drop down towards 95. So you get 20 ticks through this, which is slightly imperceivable on that chart there. But the first time, and this is the same with levels, with anything, the first time it hits it, generally gives a good reaction. If you see the reaction and go, yeah, I'm going to buy it this time, that's where you do end up in that little bit of trouble with it not reacting quite so well. And that's because people long here then start getting pushed out down here. So that first time on those really steep bands, it's got to be a steep band coming towards you, not a steep band going away from you. that's when I like to have a go at buying it. And I would apply that on an hourly chart as well. I think it works just as well on hourly. So yeah, that's probably my favourite trade on Bollinger Bands. It doesn't come up often. It's definitely quite a rare one to see. But when it happens, it generally gives you nice tight risk reward and a decent reaction first time as well. You know, here doesn't take long. This against 5-minute chart, and you're getting 30 ticks out of it within about half an hour, which is quite a nice move. What helped it as well is this is the open, and you get a straight line move on the open. So straight line move to any solid level is usually quite a nice area to buy. All right, any other questions on Bollinger Bands, on their uses? You can have a volume-based Bollinger Band as well. One of the guys in Canada, he trades off a volume-based Bollinger Band, whereby what he has, if we get back up, what he'll have is the candles are based on volume rather than based on time, and then he'll have 2 bands, and the idea being that you wait for it to break the 1 band, hit the top band, and that gives you your sell. Still subject to the same risks though, that if it breaks the top band, you get committed to selling it, and if the market trends, you're going to keep selling, or buying against the move, which, you know, by the time it gets you back on side, may or may not actually give you a profit. That's where you're going to end up having to double down each time, and it doesn't take many times of doubling down before you've used a hell of a lot of limits and are sitting on a very, very large risk. Right, moving averages. There's tons of different moving averages. I think you're best off to cut through all of the noise of it and stick with the simple ones and maybe the exponentials. If you start using adaptive and all the other different versions, you've got to question how many other people are watching it. And that's the same with all of these things. Unless other people are watching it, it doesn't matter. It's irrelevant. That's why the Fibonacci's, whilst I don't necessarily believe it's to do with them being a natural number, lots of people watch Fibonacci's, therefore people will react to them. That's what makes them important. Most commonly used moving averages, 20, 50, 100 and 200. You do get people using 14 and 21, and then even 5 and 8s as well. Again, a bit like Bollinger Bands on short time frames, I think this gives you a little bit too much information and ends up giving you too many signals to be trading off. Problem is they're backwards looking, so they only work after the close of each candle. So until you've got a close, you don't know exactly what the moving average is telling you. It's also slightly slower to keep up with the market, particularly if you're using a much longer period moving average. The basic theory of how you should use them is anything that's above the average, if the average is pointing up, you should be a buy. Below it, if the average is pointing down, you should be a sell. You can stay in until the average catches you up and then you're out. So if you're short down here, then you end up getting out. The problem is, because they're backwards looking, because they're slightly slower to adapt to the move, often you will give up a huge chunk of your move by the time you actually end up getting back to that moving average. Problems or limitations. Too many signals in markets are range bound. If a market's range bound, for me, I don't think moving averages are useful, particularly if you've got 2 or 3 moving averages and you've got them all sitting there like that. That's pretty good clue that you're in a range bound market. You don't want to be looking at them. it's lagging, so any large profit you're going to give up quite a lot before you actually get the exit signal. And also you don't get any target with the moving average, you merely get a position that you've then got to decide what to do with it. So not massive fan of them, but I do think they have their uses and there's certain situations where I think they're very useful. A more sort of fine-tuned strategy is trying to use the moving average crossover. So the idea here is you have two moving averages, you wait for them to cross, and as they cross will tell you which way you want to go. So you don't have to wait for the market to actually touch a moving average, you're waiting for that crossover. The idea is this stops you getting tons and tons of signals, and should, as long as you're waiting for an actual uptick in the moving averages, it should wait until you actually get that the beginning of a move. You're not going to get moving averages crossing or moving upwards without a move upwards in the market. So theoretically a trend has started, the moving average crossover effectively proves that it's going. Idea is faster moving average provides the trigger by crossing over. The most important thing is the direction that they're going in. What you want is the faster one crossing an upward sloping slower one. So you have a 200 average and then you have a 50 that goes through it like that. Is a much better situation than a 200 like that and then the 50 that goes through it. You get that situation, then overall it's still showing that the trend's reasonably flat. If it's changed on both, then you've got a much sort of stronger signal. Best known, the one that you'll always hear talked about on CNBC, on the news, etc., is the golden cross or the death cross, which is where the 50 crosses the 200. Got a nice load of stats on it that I found. Since 1930, golden crosses on the S&P and golden crosses on the S&P. The one on the right is when the 50 moving average goes through a 200 that's already moving up. The one on the left is when the 50 goes through a 200 that is falling. So varied results. You can definitely see a point, well, certainly for the both of them rising, where late 50s people started paying more attention to it. Late 70s, early 80s, people started paying attention whichever way it went. So again, I think that proves the point that as people start watching things, it then becomes a self-fulfilling situation that people will then start playing the trade a little bit more. I think there's probably also an element that since the late 50s, early 60s, and certainly since the early 80s, equity markets have generally gone up anyway. So most situations where you get a moving average crossover, equity markets over the next few years have rallied. So let's go and have a look at the last golden cross when it happened. You've got 200 period moving marginally higher and the 50 average coming across it. So what's going to get you in this trade? Different ways of looking at it. There's the cross. So if you're buying it here, you're buying at 2060 approximately. You're going to sit there for the best part of 3 months, neither onside nor offside in the S&P, only then to get one dropout which drops below the 200 period moving average and stops you out. Nice. So that's the first issue with it, how you actually get into this trade. So yes, you've got the golden cross, yes, it's sort of saying to you that markets should be moving higher, but your problem's always going to be how you get into the trade. What you also got just here was a death cross, and if you'd sold that, you're selling it down here And by the time you get a move back through a moving average, so back through the 50 moving average, it's pretty much bang on a scratch. So you've watched your trade go nicely on side, double bottom, and then moves back through the 50 moving average. You end up with a scratch. And that's the problem with using moving averages as a trailing stop, because of the fact that you're always going to end up giving up a large portion of your trade before you realise that you need to be getting out of the trade. So it has worked in the sense that longer term point of view, this market has continued higher. 24.35, that was July this year. S&P still beyond that as well. We have just though started dropping below 50 moving average. So that's the current situation, the S&P. There's the 50. So if you had managed to hold on, I would think this definitely stopped you out. Although that 200, whoops, is still holding, and that has not been touched since Brexit. Was the last time that 200 period moving average got touched in the S&P. So if you are holding on to it above the moving average, then you're still okay on that trade all the way from 2060, so you're still 600 handles on side. So longer time frame, I do think it works, but what it doesn't take account of is the amount of drawdown you're going to sit in and your ability to hold on to that. So I think something like that on a daily is more a sense of direction than anything else. Correlated markets, I think this works really nicely where you get a touch of a moving average in correlated markets. This is Euro stocks and DAX, and what we got is the stocks got to its moving average and pushed through it a couple of days. It didn't bounce until the DAX reached the same point. Once they both hit that moving average, then they both rallied together. So it's almost as if one will come down and sit there. When the other comes down, they sort of basically equalise, then you get the reaction together. So I've been waiting more to see if you can use a correlated market to help you out with that. Likewise, you then get the DAX just here, drops back and holds the moving average. This holds until Euro Stoxx breaks down. As soon as the Euro Stoxx breaks through it, then you get the DAX continuing, and you then get the strong flush out of that move. But until then, the DAX does manage to hold that moving average. This is probably my favourite use of it, is the exponential 20 period moving average. Use it for trend following situation, particularly when you have a strong trend, a strong move initially, and you want to try and get in. So again, it's an opportunity to get a passive entry. It's an opportunity to take a short there for that continuation lower. And with any of these type continuation trades, I'm looking for a new low. So this is a 20 EMA, and I'll use that on a 1 minute chart. I'm not going to use it on too many other charts. Again, I think you end up with too much information. The good thing about the 20 EMA on a 1 minute is because it's an exponential moving average, it stays a lot tighter to the current trade. It gives you enough space that it can pull back, but because it stays so tight, it does mean that you're consistently going to get a decent trailing stop. So your stop will pretty much, from when you get in, you're always going to be taking a profit if you get out when it gets back above that 20 EMA. And here you get the opportunity to sell it. We sit and stay below it all the way down this move, and in fact this goes a little bit lower, which you can see down there below 12,350. So nice way of getting in on moves. In terms of markets that like it, S&P seems to be a particular fan of it. Recent volatility in the S&P, it does seem to have struggled a little bit. It has sort of washed through it a bit more. S&P seems a big fan. Cable's a big fan. FTSE as well. probably because of the correlation with cable. They're probably the ones that I think work the best on it. DAX, for me, only seems to work on a very strong down move. So you get a really strong move down, you then end up with this very steep one. That's the time that I think it works. If it's this situation, I'm not so confident of it working. And that would be a situation whereby if I was in, I'd use that as a stop above it, but I wouldn't use that as a way of getting in. Exemplified nicely there. You then get this nice little flag breaks, and that will keep you in the trade. So even if you're going on the flag break, sell the flag break, and you can stay in until we get the break above it. That gives you an opportunity to add to your trade when you're already now 120 ticks on side. Give you a nice opportunity to add to the trade, which then gives you a further 100 ticks as well. That's on a 1 minute chart, obviously. So yeah, DAX not too bad for it. Cable, and this was the one we traded the other day, that little breakout on the Bank of England, breaks the little wedge. We've already seen this strong move. The first pullback after the bigger events in cable does seem to wash through it. Once you get back above it, it then holds quite nicely. Each drop back, you've got the trend to help you out. You obviously got to take account that it's not going to go back perfectly onto it. So you've got to judge that on your market. You know, how many ticks through would be appropriate in cable, in oil, in FTSE, and whatever you're trading. S&P, I usually think you don't want to see it more than about a handle through it. You certainly don't want to see a couple of 1 minute closes through it. We get a couple of 1 minute closes through it, I'm not keen on it. What you want to see is reaction. I'm happy for it to sit there, hit it, and then come away. That seems to be more of a common situation rather than it just goes bang, hits it, run away. So nice way of keeping yourself in a trade, which is what I should have been doing on this move. I think I got in, I remember, me and Ollie traded this and got in, got out. I think I might have bought it there, but again got out on like a little push back up, a push over the high, whereas I should have just been staying in it, at least to the target of 50s, and then you would have ended up getting stopped out just on the break of 40 if you were going to really try and sit it through.
Would you re-enter, say, on that push above? So when it dropped below, you stopped out, and then it's quite a big push above it again.
Oh, just hit. I wouldn't re-enter there.
No.
I'd be tempted to re-enter there, particularly as it's coming back onto these highs as well. But really, I think for these exponential ones, I'd like to see it reasonably steep and after a sort of a reasonable push away from it and back. So that, I think, would be tempting because of the fact that you perhaps want to buy it based on that anyway. So it's more sort of adding to a trade you want to do. I wouldn't necessarily always buy it once we've moved back above.
It's confidence in everything.
Yeah, I think with a lot of things, if it's already gone through it once and sort of failed it, then I'm going to step away from it unless there's more to it than just that moving average. On the way back down, once you break below it, again we stay kind of below, but again that's a bit more curve fitting. You could say that that's worked, but realistically there you're going to sit for 10 minutes, well not quite 10, 5 minutes with it just washing either side of it, and I think that's enough to make you decide that it's not going to work. Alright, shorter time frame, 200 moving averages. This is something that I do think works quite nicely, particularly the 200s. So I do always have, virtually all my charts I've got a 50 and a 200 moving average on. I'm not looking for a major move, and the key for me is we have to have not touched it for some time. I know some time is a rather subjective thing, but you can clearly see that we have not come anywhere near it for, well, that's a good couple of weeks. First drop down, out of the range, we hit it, bounce straight away back up into the range. it is a case of I'm not going to sit there with a passive bid on it. I'm going to wait as soon as it gets down there. If it doesn't push through, if I see any buy in there, that's when you want to have a go at it. That's when it gives you a nice little opportunity. And you are just playing this as a scalp type trade, run it back up. You're not looking for anything massive. Also provides a nice little target on a short. So if you were short as we came back into this wedge, that's where you can start looking. You've got two lows. Moving average comes in pretty much the middle of those two lows there, so it provides a nice little target. Then this is what happened next. So you got the reaction. Once you're through it though, I would then, to start with, be willing to go the other way against it. If this had then gone back through here, I'm not going to worry about it, because that's then where I feel that we're getting flat, and I feel that the market's not going to move one way or another. But the first time we've broken through it, it's not been tested for a long time, we then hold below it. It coincides nicely with this sort of downtrend wedge, and that again helped spark off this much larger move that we got in the S&P. Another example of a short time frame one, this is cable, also holding that 38 retracement. However, it didn't so much there, so I wouldn't necessarily be using the 38 as a reason for it, but you can see the little dip through the level, and again bang on that 200 moving average. The other stipulation I have for it, if you will, is it does need to be moving up or down. I don't think, if we've not traded near it for a while and it's virtually flat, that's not one I think is important. I think it's got to be pointing upwards or downwards, so it's clearly showing sort of trend in that direction. That's the point that you know that people are going to use this as an attempt to get in a long position rather than just trying to buy it anywhere. So watch out for the sort of direction of it. Incidentally, I've just watched both the Bund on that breakdown, nice little target onto that 200 moving average. This is on a 5 minute, so I'm a little bit less keen on it. But again, if you wanted a target on a trade on the break of this little range, it does give you quite a nice little target. And we've then got a little bounce from it. Also, and this is why I suggest that it's always more a scalp trade than a hold on to it trade, is in the DAX on a 15 minute. Just there, we started turning down on this moving average. We get a test up, hit it just below 70, get a pullback towards 50. So you get 20 ticks on that first hit. We break it, and actually we break it right onto the 50 moving average. Again, I think that's a bit trend fitting. It's nice to say, oh yeah, it worked on the 50 as well, but it's not exactly been a long time since we've hit it. Yeah, it's coming off a little bit, but that's not so convincing. I think if you're looking for a short, if there's a reason to sell it and the 50 comes in just there, then fair enough, but I'm not overly keen on that one. But this first one just here, that 200, is virtually the top of this little range anyway. Nice little first test up to it, hits it and comes back. So I do think they work on those shorter time frames, but they definitely work more as a sort of scalp type trade. So take your winner, be happy with your winner, and move on. So yeah, has anyone got any moving averages on their charts?
Yeah.
Sorry?
No, just VWAP, but that's not
Oh, right, fair enough. Yeah, like I said, they're the only ones I really use, and the 20 EMA is only on a 1 minute chart. I don't think that, once again, you can end up using too much information. It just sort of giving you more and more trades. And that is the lot on moving averages. So we've actually managed to get through all the indicators, which does mean that exercise time is going to be bigger. Now it's going to be a good challenge for you for hopefully we pick up a little bit more energy going into the rest of the week, and you can have a good session Thursday afternoon, Friday morning, cut and reverse exercise. Then we'll have a little chat about it on Friday afternoon. We'll see types of trades people ended up in, how people ended up getting caught if they did, or how people managed to stay in those trades. Anyone got any questions? No? Good stuff. Any questions on Lime, Peter, Leeway? Golden Cross and Dead Cross are wived by many people. Yeah. Original mind. Yeah, I think Peter's agreeing with the sentiment that, yeah, it's a nice idea, everyone watches it, but the difficulty is the actual trading of it. All right, if there's no questions, we'll leave it there. We're going to do risk management and order execution tomorrow. And then we'll do a bit on trading psychology on Thursday morning before exercise in the afternoon. So that's planned for the rest of the week. So risk management tomorrow. A joyous topic that is, but it's quite a useful thing to sort of get you thinking about how you do actually manage your risk, and also how you assess the sort of risk reward on trades as well. All right, I'll leave you to it, guys. Have a good afternoon, and I'll speak to you all tomorrow morning.